In this lecture, I'd like to discuss two types of costs, accounting costs and economic costs, and highlight the differences between the two. Now, it's been said that the art of business consists of identifying assets in low-valued uses and moving them from lower to higher-valued uses. Key word there is value, and if we want to understand value, value entails both costs and benefits. And so to really get into the nuts and bolts of moving assets from low to high valued uses, we need to understand at a detailed level the costs and the benefits that affect value. And in this lecture, we're going to focus on the costs and some of the key characteristics of what economists mean when we talk about costs. Now, there are a few main takeaway points in this discussion. One of the main, probably the biggest takeaway point is that costs and decisions are intrinsically related to one another. And at any point in time in economic analysis, if you find yourself getting confused, I find that it's often helpful to step back, refocus your analysis, and articulate the decisions that are being made. If you start with the decisions and an articulation of the decision to be made, very often that helps you identify the costs that are relevant to that decision. And a second takeaway point is that when comparing alternative decisions, from an economic standpoint, really the analysis is fairly straightforward. We want to compute the profit or profitability of each alternative and then pick the highest. Now, the very act of comparing multiple projects brings up the idea of an opportunity cost. An opportunity cost is the profit that you give up in order to pursue a particular investment or project. Opportunity costs are one of many relevant economic costs. And a third takeaway point is that when making an economic decision, it's extremely important to consider all of the costs and benefits that vary with the consequence of that decision, but only those costs or benefits that vary with your decision. The costs and benefits that vary are the relevant costs from an economic standpoint. Now, we're going to talk a little bit about fixed and variable costs. Fixed costs are costs that do not vary with the consequence of a decision. Variable costs in general are costs that do vary across decisions or with the consequence of your decision. And so we're going to be focusing in many times on the variable costs because those are the ones that are intrinsically related to the economic decision that's being made. Let's consider an example of a coal company burning two types of coal mined out of southern Wyoming, 8,800 BTU coal and 8,400 BTU coal. And those numbers simply represent the amount of energy contained in 1 pound of coal. When the price of the 8,400 BTU coal, which has 5% less energy, fell more than 5% below the price of the 8,800 BTU coal, the plant manager made a decision to switch over to entirely 8,400 BTU coal. Now, at a basic level, that makes sense, even though it generates 5% less power. If the cost is more than 5% below that of 8,800 BTU, the intuitive appeal of that is that it's going to lower the average costs. Now, the manager was in fact compensated based upon the average cost of the coal that was being utilized in the plant. So it would appear that the incentives of the manager were aligned with those of the power plant, and this decision made economic sense. But in fact, the profit of the company went down. Now, we could look at this and ask, what happened? And if we can figure out what happened, what can we do to improve upon that decision? The output of the plant fell by 5% when the manager switched over from 8,800 to 8,400 BTU coal. Why did that happen? The reason that happened was that the plant was already at full capacity. And when they switched from the higher energy coal to the lower energy coal, the total amount of electricity generated at the plant fell by 5%. As a result, the parent company had to replace that lost energy with natural gas, and the natural gas at that time was selling at a fairly high price, was fairly expensive. And the net result was that the overall profit for the company actually went down when they switched to the lower cost coal. Now, very simple example, but we can glean at least 3 lessons from this. One lesson is that a good decision must consider all of the costs, in this case, all of the costs of switching to the lower BTU coal. The cost of replacing the lost electrical output was in some sense an implicit cost, but nevertheless one that was very real and that was borne by the parent company. A second point is that the average cost can be a lousy predictor of the plant's performance. And we'll see time and time again that it is often the case that the marginal cost, not the average cost, is one that leads to better economic decisions. A third takeaway point is that problems will inevitably arise when the incentives of a business manager or a particular business unit, in this case the power plant, are not aligned with the goals of the overall parent company. So even though it would seem that the manager's incentive was relatively well structured, focusing on average costs, it was not aligned well with the parent company's incentive of overall profit maximization. So how could we fix this problem? One simple way would be to more closely align the manager's compensation or incentives with those of the parent company, somehow taking account not only of the average cost of coal, but of the overall impact of decisions on parent company profitability would be one step in the right direction. We talked about fixed costs, or I mentioned fixed and variable costs earlier. Fixed costs are those that do not vary with an economic decision or the consequence of an economic decision, while variable costs are costs that do vary with the consequence of an economic decision. The firm's total costs are simply the sum of the fixed and the variable costs. One way that the big coal power company might begin to more fully align the manager's incentives with that of the parent company would be to have an incentive structure that accounted not only for accounting costs but also economic costs. What's the difference between accounting and economic costs? Well, accounting costs tend to recognize explicit cost items, costs paid to suppliers for the input goods, general operating expenses, depreciation expenses, interest expenses, which are the cost of the capital borrowed from the bondholders or debt holders. All of those are explicit expenses, and all of those expenses show up on a firm's accounting income statement. One of the largest implicit costs that does not show up on an accounting statement or an income statement would be the payment to stockholders, or the expected or required return from the company's stockholders. Ideally, the profitability of a firm should recognize all implicit costs, and one of the key costs for any firm would be, or any firm that has publicly traded stock, would be the cost of the equity capital, or the capital that shareholders have loaned to the company. So economic profit is a measure of profit that makes explicit the cost of shareholder supplied capital. Economic profit does this by simply taking the accounting profit and subtracting off the cost, the dollar cost of the equity capital supplied by stockholders. If the economic profit, which equals the accounting profit or net income of the firm minus the equity cost of capital, if the economic profit is positive, what that tells us is that the firm is earning more than the equity holders expect. On the other hand, if the economic profit is negative, and it can oftentimes be the case that even though the firm has a positive net income, the economic profit is negative. If that's the case, what that tells us is that the firm is earning less than the equity holders would expect, even though the net income is positive. From a shareholder standpoint, economic profit makes sense. And from a manager's standpoint, it makes sense as well, because it makes explicit one of the key items that's not found anywhere on the income statement. That is, the cost of shareholder equity capital. Now, how to actually calculate that is beyond the scope of this lecture, but at a big picture level, it's typically calculated. The dollar cost of equity capital is typically calculated as the amount of equity capital times some percentage rate of return that represents the rate of return that the shareholders expect. So the three key takeaway points from today's lecture are, first, that the cost-benefit analysis done by economists requires us to consider all costs that vary with the consequence of a decision, and only those that vary with the consequence of a decision. Second key takeaway point, just a kind of a hint from an economic perspective, anytime you find yourself getting confused when doing cost-benefit analysis, step back and refocus on the decision, the fundamental decision that's being made. And third, economic profit is a tool that we discussed briefly and introduced. It's a tool that allows managers to account for all costs, not just explicit costs. Thanks for listening.